gives me great pleasure to now bring on board Dr. Anish Shah, Deputy Managing Director and Group CFO with Mahindra and Mahindra. Dr. Shah, welcome to ET Now. It's the first time I'm personally interacting with you on this forum, so a very warm welcome and hope everything with your family and with employees of Mahindra and Mahindra is safe.
Thank you, Nikunj. It's a pleasure to be here. And yes, things are good given the circumstances, and hope everyone at your end is safe as well.
Well, thank you very much, sir. Let's start with the big picture question. We heard you on Friday, but what you shared was largely your numbers for the quarter gone by. The lockdown effect is visible now. Now that lockdown has got lifted, what is your understanding of the economy, and especially on the demand front, how are things looking up for Mahindra and Mahindra?
So, Nikunj, the rural economy is actually doing very well. Our farm business sold more tractors in May as compared to May last year. And that honestly was a surprise for us as well. We are seeing a fair amount of income and spending capacity in rural households. They have not been impacted by COVID as much. Similarly with auto as well, we are seeing a lot of demand from rural sectors and also demand for our small commercial vehicles. So tractors have gotten back more or less similar to where it was in pre-COVID. We have still some way to go. From a demand standpoint, it's strong. From a supply standpoint, we are at roughly about 85% of capacity utilization right now, and we have the remaining 15% to go. Suppliers are online. There are some challenges in terms of completely ramping up, but they're fairly small at this point in time, given the overall situation. For auto, it's going to be a slightly longer haul. Auto in May was 20% of what it was last year. It's ramped up since then. Today, it will be roughly about 40%. But for auto to go back to 80 or 100% will take a few more months.
So if I look at your revenue split, and I'm looking at your revenue split for the tractor business, which now accounts for more than 30% of the business. So can I say that the 30% business, which is the tractor business, is in good shape, both in terms of demand and also in terms of market share? Because demand is something which you've referred to, and market share is what I would like to flag off. Your market share is north of 40%.
Market share is not the 40%. We actually grew market share by 1% last year. And we feel that we should be in a good position to grow it this year again.
But the fact that you are losing market share in the UV market, and you've already said that the auto business will take some more time to come back, how much of drag will that be on the aggregate picture, at least on the automobile front?
At this point, Nikunj, numbers for this year are pretty open in terms of what finally happens with COVID, and whether there is greater demand to make up for losses for a few months. We don't know all of that as yet. If I were to look at the auto business, if we look at a small commercial vehicles, we actually gained market share there last year as well. We went from 44.5 to 45.5% market share there. And that's a pretty significant segment for us. That is doing well, and we're starting to see a good demand for that segment right now as well. UVs have really become much broader today to include a large number of passenger vehicles as well. And we have lost some share on that front last year. But there we are hopeful to at least manage to maintain our own over the next few months. And then with a few new launches coming up, start growing that as we go forward.
Let's define the automobile business for Mahindra and Mahindra. It's a tractor company which then moved into big SUVs, and now you've also stepped into the EV space and also the mobility business. So if one looks at Mahindra and Mahindra, they've got two parts: the tractor business, which is rural dependent, and the automobile business, which is a combination of rural as well as urban. And then you've got a mobility business, which is a future business. So if one has to understand the Mahindra and Mahindra auto piece, how would you like to identify it for your shareholders?
So we've got strengths in large SUVs, and that's something we've demonstrated over time. We have made some headway in MPVs with the Marazzo and smaller SUVs. But what we're going to look at right now is how do we continue to consolidate our strengths that also link directly with our strength in small commercial vehicles. So that's one area. The second area is around electric vehicles. We have a lead there in terms of the fact that we were the first ones in India to manufacture electric cars. And we've had that capacity for the last 10 years. So our lessons from that in India are significant. And that we would say is at the low end of the electric range. At the high end, we are launching a global vehicle under the brand Automobili Pininfarina. And that will bring us technology from an electric vehicle standpoint. So we feel we're fairly well positioned there as well. It will take some time for the EV market to really scale up in India. But as it does, we are well positioned to take benefit of that.
One very important indication which has come on Friday and what brokerages are quoting this morning, I just want to spend some time with you, is that you've come out, or the management has come out and said we are going to be very conscious about a capital allocation strategy, and loss-making subsidiaries may not find too much of weightage in our aggregate future, in our future capital allocation policy. Let's talk about it.
So, Nikhil, let me at least take a step back here, because there has been a lot of pressure from investors, shareholders around what's happened to the Mahindra stock price in the last year or 2 years. And is Mahindra really getting the value for what it stands for? And as we talked to analysts, we essentially had to go back in time. We went back to 2002. We said 2002 was when the Nifty was started. At that point in time, that was also the birth of what we call the Blue Chip Leadership Conference at Mahindra. And that conference was essentially to focus on how do we showcase value and how do we ensure that Mahindra meets its full potential. From 2002 to 2018, over a 17-year period, Mahindra was a top-performing stock in the Nifty with an annualized growth of 31% every year. That was driven by very strong underlying performance from an EPS standpoint, which was 34% annual growth in EPS and a 22% average ROE. That was also underpinned by strong cash generation at about 2,000 crores a year. If we look at what happened after that, we had losses in international subsidiaries start in fiscal 18. That became slightly larger in fiscal 19 and even larger in fiscal 20. Our cash generation was still strong. We actually generated a lot more cash over the last 3 years than we have prior to that in many years. But our EPS was hit because of the losses in international subsidiaries. So that's the reason why we have to tackle that head on. And in fact, we're going back to what a capital allocation policy was for those 17 years where we had an excellent run in the market. And we're going back to tightening that up, making sure that there's a clear path for every loss-making business. Either it can make profits at an 18% ROE, in which case we will stay with it if it has a path to doing so in a reasonable time frame, or it should have a quantifiable strategic benefit. If it does, for example, Sampo makes agricultural implements. Implements is a nascent market in India with huge potential. So the investment we made in Sampo is really to have them come into India and tap into that nascent market, where the benefits will be far greater than the investment or the potential losses that may take place at Sampo itself because of that transfer of technology. And as a result of that, that is a company that we want to stay with. There are similar examples of companies internationally that bring us technology. So this is not about getting away from international. We will stay with international, but in a very careful manner, where we have a clear link. And for companies that don't have a clear path to profitability or don't have a strong strategic quantifiable link, we would get on an exit path, either through a partnership alliance or shut them down.
So one investment which in a sense has been a big baggage for Mahindra and Mahindra, Ssangyong. What is the future of that company?
So our board has decided that we will not invest anymore in Ssangyong. We would very much want the company to succeed and have taken all non-monetary actions to help the company succeed. Our board, when they made the decision, also said that we will give a final investment of 40 billion Korean won, which is $32 million or 240 crores into Ssangyong, which was done last quarter. And as a result of that, that has given Ssangyong some runway. There are investors who are looking at Ssangyong, and as they come in, they would help take the company forward. We again want to make sure we do everything to get the company forward, but we will not invest anymore.
Okay. Now, according to our numbers, roughly 40 to 45% of your total capital employed from the standalone company goes into your subsidiaries, and which historically have dragged your return ratios down. So are you looking at a substantial drop in fresh commitment there? And if you're looking at a substantial drop in fresh commitment there, then on an aggregate picture, I would imagine that your return ratios will suddenly start looking up.
They will start looking up. And see, that was again for a specific year. If you look back over time, we've always invested a fair amount of capital in auto and farm businesses. Even if you look at F20, let me share some numbers here. Our auto and farm businesses generated 4,300 crores of cash in fiscal 20. We put in 4,447 crores of capex and 1,700 crores of investments in companies that had a clear strategic benefit for auto and farm. So from a net basis, we actually invested 1,800 crores more than they were generating. Our investments, as we call it, which is in listed entities and non-listed subsidiaries, generated 1,900 crores of cash for us. So as we look at it from that perspective, our auto and farm businesses will always get the capital they need. They are strong businesses and will continue to grow. And our investments really haven't taken up as much cash over the years. Many of them have been started with very small amounts of capital. And if you look at the returns in many of these businesses, they are very significant. In some cases, we're looking at 40% plus IRRs over time. In some cases, it's 25 to 30%. So we feel that we have been able to harness the value of these investments. And that's something we will continue to do.
The ultimate mantra of a management is to create value for the society and create wealth for shareholders. While the Mahindra Group has managed to touch and change a lot of lives and change the way how things are moving at a social level, at a shareholder level, your stock is not getting duly rewarded for the kind of investments you are doing. Why is that?
And here, Nikunj, memories are short, right? So your statement's absolutely right for the last 2 years. But as I said earlier, if we look at 17 years between 2002 to 2018, Mahindra was the number one performing stock on the Nifty at a 31% annualized growth. So our challenge is to get back to that 17-year history and get out of what happened over the last 2 years. And to answer your question directly, why is that? That's because there were a number of international subsidiaries that, for a number of reasons, did not perform as we wanted them to. So there were some things that happened there, some things that were accelerated by COVID as well. And we are now taking very stringent actions to get out of those or put them on a path of profitability. And therefore, that will get us back to where we were before. And even if you were to look at it, in terms of our numbers this year, 80% of our exceptional items were driven by Ssangyong and Gen Z. Ssangyong, we've decided not to invest anymore. And Gen Z is a US business in two-wheelers, which we have shut down as well. So that 80% has been addressed. The remaining 20% now needs to be addressed, which over the next 12 months, we're looking at every single business with a very fine scan and understanding whether we can really get them back to the path of profitability. Some we can, and some have very good technology as well. But there are some that we may not be able to, and we will have to look at a sale or an exit.
In hindsight, when you look back at the last 10 years of expansion for Mahindra and Mahindra, from building a formidable financial franchise to investments, let's say in the agri business, in the Mahindra electric business, or for that matter, mobility business, do you think the group somewhere diversified too much?
See, Mahindra has always stood for the gateway to the largest and fastest growing themes in India. The question is, can we generate investor return? Over 17 years, we've shown that. Over the last 3 years or 2 years, we haven't. Again, more because of international subsidiaries, not because of our diversification in India. As we look at returns from businesses that we've set up in India, they have been very significant. So the question is, can we replicate what we've done for those 17 years? And that's what we're getting back to.
No auto company in the world, Mr. Shah, can claim that they have a tractor business, they have a mobility business, they have a two-wheeler business, and also a strong SUV business. Can all these businesses coexist?
If you think of the synergies there, think of sourcing. That's a key part for all of the businesses. And what we're doing now is looking at quantifying all the benefits. Our margins are very good, and you can compare them with margins for other companies in the industry. Why are they higher? They're higher because of some of the synergies that we get here. Now, the question is, can that translate to our performance from an investor standpoint? And that's what we've got to drive.
Okay, let's talk about the non-core businesses which are not connected, let's say, with the auto theme or with the rural umbrella. What about some of the non-core businesses? I mean, Mahindra Holiday, some would argue, has been a great investment for you, but it would be called as a non-core businesses. Are you looking at diversifying in non-core businesses also?
For the next few years, I would look at harnessing 9 gems that we have. These are businesses with tremendous potential, and we feel that all of them are potential billion-dollar candidates. This includes our agribusiness. This includes Mahindra Rural Housing Finance, Excello, which has auto recycling plants, Mahindra Electric, Mobility, Sustain, which is a solar business, our aftermarket, a used car business, where we really have a very strong physical infrastructure, and a Powerall business. So these are businesses that have tremendous potential, and we would look at scaling them up. The plan is not to go out and diversify a lot more beyond our current footprint. If something outstanding comes up, yes, we will look at it. But we feel that with these 9 businesses, we are well positioned. The Ford joint venture allows us to supply to the world, and that's something we want to do for some of the other businesses as well. And with that, I think we've got a very strong portfolio that can generate good returns as we look at the next few years.
Some of your companies will also need capital, existing big companies. For example, Mahindra and Mahindra Financials, they've just raised capital. Mahindra Life, as they will grow, they may need capital because in the real estate business. Tech Mahindra doesn't need capital, but other businesses would need capital. Are you committed to maintain M&M's holding to the current levels, even as some of your subsidiaries go and hit the market to raise capital for their operations?
Mahindra Finance, we are maintaining 51%. It is a key strategic business for us because financing is a key element for auto and farm as well, and that's where the business was set up originally. It has expanded beyond that and has been growing very well, is very strong right now. It is raising capital because it wants to stay ahead of the curve and ensure that there is no question at all in terms of its solvency or liquidity. Mahindra Finance has always raised capital well before it's needed it. And that is something that we feel is a prudent thing to do. And with our support, we are seeing a very strong business in Mahindra Finance as we go forward. For other businesses, we will look at it in terms of what is a potential return on investment, and does that really make sense for us? Mahindra Finance has demonstrated a very strong return on investment and continues to do so. But that's something we have to see for every business which will need capital.
The last group company which went public, I guess, was Mahindra Logistics. Can I say that the gems which you mentioned right now are too small and no new company is likely to go public for next 3 years?
It will depend. There are some that we feel we can scale up faster, so I can't give a specific time frame. But my sense is it is reasonable to say that at least for the next 2 years, we will not see any company that goes IPO. But after 2 years, we could start seeing some.
Some of these companies may not need capital, but they do need strategic alliance. We've seen that how Reliance Jio has also gotten a lot of strategic alliance with a partnership with Facebook and others. Are you open to a lot of strategic alliance? They may not be financial investors, but strategic investors in some of your new economy businesses?
Yes, we are open to that. We have recently brought in a strategic partner for our asset management business. Manulife has come in with a 49% stake, and that's just one step. Reliance has done it exceedingly well, and that has opened the door to a lot of thoughts around what are other strategic partners that can benefit our businesses, and that's something that we will look at.
We spoke about Mahindra and Mahindra stock price trading underperforming. Now, that could be a market cycle, that could be market positioning. I'll leave that conversation aside. But even if I look at some of your other group companies, let's say Tech Mahindra or Mahindra and Mahindra Financials, I mean, Ramesh is doing a fantastic job in running it. But if I look at the price to book for Mahindra and Mahindra Financials or the P multiple for Tech Mahindra, all of them are trading at a discount. And I sometimes get puzzled when I meet your individual CEOs and I normally ask them this question: why is that?
So Mahindra Finance, if you look at it right now, it's been hit by the woes in the financial sector, specifically NBFCs. All NBFCs have come down very significantly in price over the last 3 years, and last 3 months rather, and that's where you're seeing the discount. But Mahindra Finance is a very strong, solid business, and sometimes strong, solid businesses may not see that kind of growth that you want, but even there, I would say that Mahindra Finance's growth record has been pretty good. From any finance business standpoint, I'd prefer to have a strong, solid business first, then explosive growth that could potentially turn into problems in future. And therefore, we feel pretty good about where Mahindra Finance is. It is growing at a reasonable pace. It's growing at a measured way. Its price to book ratios were very healthy as of the January or February timeframe. Today, they are not, because the market is concerned about what will happen to NBFCs. But if they see Mahindra Finance come out strong at the end of it, we will get our rewards for it, for having a strong and solid company.
Just 2 more questions, Mr. Shah. We've really extended our appointment with you, but you've been so candid that I'm taking the liberty of extending it slightly a bit more. There are 3 ways in which we are dividing the economy at ET now: survive, revive, and growth. Now, none of your group companies will have a survival problem because it's backed by Mahindra and they are good companies. So I'll keep the survival part aside. Let's divide the Mahindra group of companies into revival and growth. Which part of your group will see revival in next 12 to 18 months, and which part of your group will see the growth largely because of the new normal?
Little slower to come up. The tractor business, I would put maybe between revival and growth, because we are seeing a fair degree of demand from rural markets already. Businesses like some of the gems we talked about, aftermarket, Excello, with a policy expected for auto recycling, that can be a significant growth driver for Excello. And similarly, many of our other gems, agri in particular, with some of the recent policies around agri, could be positioned very well for growth.
Okay. Now, in this lockdown, for Anish Shah, what has been the toughest moment and what has been the most joyful moment?
Moment is making sure that we are doing everything to have our employees safe. There has been concern from employees around what happens if someone is tested COVID positive. How are we ensuring that first, at least when we open up plants, we maintain social distancing norms and everything that goes with it. And then in the event, whether they're coming to office or whether they're not coming to office, if they or their families are tested positive, how do we ensure that? So that's been the toughest part of making sure that all our employees are safe and secure. And I'd be happy to say that we have a very comprehensive program that is in place, and some more is being rolled out for employees, where they can call in a panel of 25 doctors that we have on staff for any questions that they may have with regard to certain symptoms they're seeing. The ability to get tests done quickly and reasonably, and then the ability to have, again, telemedicine provided by a panel of doctors, home quarantine facilities be provided, and then extra care beyond that as well as required. So that's been, the one part that I'd say has been tough from the standpoint of making sure that we're doing everything we can, but we are glad that today we're in a good position. The joyful part has been just being in a group like this where everyone, all our leaders are looking first as what can we do for community, and working together with the community on a large variety of things. So that DNA of the group has been something that really has been very joyful from my standpoint.
Well, really appreciate your time. Thank you for being so candid and open about what the group plans are and how the group essentially is looking at rebooting themselves in terms of the subsidiaries and the future capital deployment. I really hope that markets they recognize that, because in this kind of an environment when one has to really vote for certainty and corporate governance and a group which is focused around all ESG activities, I guess Mahindra Group needs no introduction, but I'm sure it's a matter of time markets and investors will recognize that. Stay safe, sir, and thank you for joining us.
Thank you, Nikhil. Pleasure to be with you. Take care.